Hey everyone, my name is Mike Sowers. I'm with Commercial Investors Group. I'm also the fund manager of the Alpha Div Real Estate Fund. Lately, I've been having lots of conversations with commercial property owners. Maybe they own one property or a portfolio, and they're trying to think about how do they simplify their life. They're getting more advanced in age. They've realized they have to do something. And really, I see that there's 4 key options that they have. So this video is really to run you through those options. Number 1, of course, is do nothing. We know that you get a step up in basis when you pass away and your children will inherit the asset. Business owners that own commercial properties that we've been talking to have also realized that leaving the real estate to their children not only is a risky strategy if the kids aren't in real estate, but it also can be a burden. It can overcomplicate the estate. The second thing is that there's risk of loss because you still have debt in place. You have debt service coverage that you have to meet. And you know, oftentimes commercial properties require the owner to do all the asset management. So that's making decisions on who you're hiring for leasing, who you're hiring for property management, are you holding them accountable? So even if you have vendors in place, there is a certain amount of headspace, a certain amount of time. And then if the roof caves in or a tenant defaults and you got to place them, not only do you have lost revenue, but you have to pay a leasing commission. Oftentimes there's a tenant improvement allowance that needs to be put in place in order to win that lease. And so you're putting money constantly back into this thing. And so that can also be a burden on the estate if you pass away. The second option is to 1031 into another asset. Now, if you're looking to simplify your life, 1031ing into another asset that you actually know less about than your current asset just really doesn't make any sense. But there is a thing called a Delaware statutory trust. What this allows is it allows you to transfer ownership of real estate into a financial instrument. Essentially what they've done is they found a loophole that the IRS has blessed, but they blessed it with one stipulation. DSTs have to have at least 90% of their assets in stabilized properties. So what are we typically seeing for DSTs? These are big apartment development projects. You're buying them at top dollar, full market price at the highest multiple because it's being bought at a fully stabilized price. So although the dividends may be decent, like 4 to 5%, the value growth actually is probably not going to be there. It's just going to be the organic value growth. It's not going to be a value-add investing strategy. And what that really does is it exposes you to the highest level of market risk because the loan is so high relative to the market value. And then also if the market corrects any, it could actually eat into your investment base. I know many DSTs out there today actually have a current market value that's lower than they have invested into the property because they bought it at a 5 cap and now the interest rates are 7% and the cap rates have gone up. So be careful about DSTs. They're actually potentially one of your worst options. And I'll show you a spreadsheet that actually puts some numbers behind all these to kind of back up the conversation here with some actual numbers. So the third option here is to pay tax and put your money in the market. Now, liquidity is key. I think that you have to solve for liquidity for your estate. For some people, that's $500,000. For some people, that's $3 million. My recommendation is you solve liquidity in the near term by figuring out what is the actual amount of liquidity that you need, and you maintain that portion in the stock market. Oftentimes what we can do though is we can refinance or pull some cash out of these assets well in advance of doing one of these strategies tax-free, invest that in the market, gain some liquidity. But oftentimes what we see is that people are over liquid. They have way too much in the market, and guess what comes with the market? Well, one, if you sell your assets, you're going to pay capital gains, and most people who are more advanced in age that have held these assets for a long time, they've depreciated them down quite a bit. So you're probably paying overall between 30 and 35% on whatever the sale price minus transaction costs and your investment basis, that gap. So the second thing is when you put your money in the market, you're paying a load to your financial advisor if you invest through an advisor. Oftentimes that's 50 basis points is the lowest I've ever seen, 125 basis points on the high end. Most people are somewhere in the middle there with a registered investment advisor. In order to get dividends, you have to keep liquidating stocks in order to pull cash out of those. And if those stocks had a capital gain, guess what? Your income tax when you're liquidating that. The other thing that I think is key is that you're really volatile. The beta in the stock market, even the S&P 500 and the Dow, is quite large compared to real estate. Real estate, historically speaking, is a much more stable, predictable, and reliable investment vehicle. In fact, studies show when you add real estate, even in a publicly traded REIT, to a publicly traded equities and bond portfolio, that it decreases the beta significantly. So the lack of dividends for some people can be a real concern here. The fact that you're going to pay taxes, though, this actually is the lowest investment base. This is probably the worst option. I want to talk about the last option, which is the 721 exchange. Now, if you're not familiar with the 721 exchange, unlike a 1031 exchange where you're selling one asset and you're trading it for another asset, this is selling equity in a company and trading it for another one. So you're basically trading your equity in that company for equity in a real estate fund. That fund now owns your company that owns the assets, but it also owns many other companies that own assets. So you go from, let's say, owning 100% of 3 assets to owning 3% of 100 assets. That's kind of the general idea. The big benefit here is diversification. You're not exposed to maybe a small portfolio of tenants. You have a much, much larger portfolio. So even if one asset's not performing as well as expected, it's going to be lifted up by all the other assets. The second thing is you're going to get dividends that are historically higher than single asset dividends, because of that diversification and the risk mitigation spread across the multiple tenant base. Perhaps the highest thing, though, is that you don't pay taxes. It's tax deferred. You get the higher investment base and you transition that in. Now, let's say you did the DST. You get your proportionate share of the depreciation from that one asset. On the flip side, if you roll into an open-ended fund through a 721 exchange, as that fund continues to acquire assets, assuming that bonus depreciation is still around, we can actually accelerate the 5, 7, and 15-year property through a cost segregation, and that additional allocation gets transferred back to the owners of the fund. So in the 721 exchange, if you go into an open-ended fund, you're actually going to get the highest level of depreciation benefits. Now, that can benefit you in one of two ways. The first way is going to be it can offset all of your dividends. Typically, and historically speaking, for the Alpha Div Real Estate Fund, our depreciation has exceeded our dividends every year. The second thing is that if you qualify as a real estate professional, you can actually use these passive losses to offset other ordinary gains and capital gains that you might be getting through other stock investments or the sale of businesses or other retirement vehicles that you're pulling cash out of. The last thing is you'll see from the financial analysis, not only is this starting with the highest investment base, but it's growing at a much higher rate. So if this thing's growing at low to mid teens per year relative to, let's say, the stock market at like 8 to 10%, relative to a DST, overall yield is probably in the 5% range from what we've actually seen for real performance. And then if you do nothing, your equity, if you've stabilized your properties and you can get max sale value for them now, the chances are your return on equity that you're getting here is much, much lower than if you pulled that equity out, you put it into any of these vehicles where that equity is actually compounding and growing at a higher rate of velocity than it does in the stagnant asset, just based on market appreciation.
Hey, this is James, Alpha Div Real Estate Fund. I'm going to talk through a few of the options that Mike referenced here, and I'm going to show you the 4 different ways. So the first one is you sell your assets and you pay taxes up front. That's in red. That's investing your returns back into the stock market, which in that case, it will grow. So if you look at the angle of the line, you'll see that it does grow over time. And the other 3 options, you don't pay your taxes up front, you're deferring those. The one in yellow, that's 1031 into a DST. So you're actually, if you look at the angle of that line, you're really getting, because they're buying stabilized assets, you're not getting a ton of appreciation growth. The blue line is, you can see that if it's your property's already stabilized, you're really getting probably the organic appreciation from rent increases over time. So that line isn't as steep as well. The green is invest into a fund that's the highest return possible. And you can see the angle at which that grows. So when you look at the green and the red, they're really growing at a fairly solid return. The problem is you paid all your taxes up front in the red, so your investment basis starts off a lot lower. And so it just doesn't compound enough to really get you the growth that you would in the fund. If you look at the right of the graph, you'll see where you actually pay the taxes on the back end. So in all 4 cases, you're paying capital gains. The difference is In the yellow, green, and the blue, you're actually paying not only the taxes from the gain, but also the original taxes that you had deferred. So that shows a sharper decline on the back end. But in the red, of course, you're paying up front and you're only paying the capital gain on your actual appreciation of growth over time.
I'm going to share a few example videos of people that we've transacted with.
Hi, my name is Sean Tharp. Mike's group approached me about doing a 721 exchange. We talked about 2 or 3 different options: selling it flat out, doing a 721 exchange, doing seller carrybacks, etc. And after reviewing my options with my accountant and looking at what my tax ramifications would have been after recapturing all my depreciation, assuming the returns continue as they have over the last 2 years, I think it will be, I've got all of my money working for me instead of, let's say, 30 to 40% of my money working for me. I don't know. I just, in the end, I just felt I'd rather have all of my money working for me versus having 30 to 40% of my money working for me. It just seemed like it was a better fit for me.
My name is Grant Parr, and I'm a controller. We had a building that we built a long time ago, and we've operated for a while. We had one really big tenant in there for many, many years, and their final lease came up and they moved out. So we continued to hold the property, try to get it leased up, but the building was a bit of an odd shape. And so we'd really had to put a lot of money into it to kind of reconfigure the building. So we weighed a lot of our options, thought about just going ahead and selling it outright, but didn't want to eat the capital gain on that. And also didn't want to have to be subject to the strict timelines that you have to follow with the 1031, because we didn't really have anything that we were looking at the time. So we kicked around the idea of a 721, and then we actually got the marketing from you guys and kind of learned about it, gave you guys a phone call, and we all negotiated a fair price, and you guys sold us on your fund and all the opportunity that you have coming along with that fund. So it really made a lot of sense, not having to go and pay a big capital gain, all the depreciation recap, and just really rolling that building into equity into the fund to then get a steady stream of dividends and tax benefits as owner of fund with many, many assets.
Hi, I'm Jerry Green, and got a letter from these guys telling me how I could save some money on a building I had, and we put a deal together with them, and we're looking at about 4 or 5 months into the deal. So maybe we'll put another building in as things go on.
Hey, this is Corey McClure. I'm here at the Alpha Div Partners Wild Hockey event. I've been investing with Mike Sowers and James Smith for years. I invested with them on a Science Center Drive in New Hope. It went fantastic. Invested in the first tranche of the fund and the second tranche of the fund. Now I'm helping out as a partner.
I've been investing with Mike since 2020 after the pandemic hit. We found some awesome assets that weren't being managed well. We improved the management, greatly improved the prices, and we did 721 exchanges into a CIG fund. And through that process, I made well over $1 million tax-free of shares in the CIG fund. I've got enough confidence in it where I'm looking at putting more into it and buying more properties with them now.
Hopefully this discussion's been helpful to have you weigh a few of these out. We're one of the leading experts in 721 exchanges. So if you have any additional questions or this is a strategy you want to take a look at, feel free to reach out and book a call on my calendar. Mike Sowers, Commercial Investors Group. Thanks.